All right. So good evening, everyone. My name is Vikas Agrawal, and I'm the founder of AIF and PMS Experts India. Firstly, I want to say that Happy Republic Day to everyone. It's a very auspicious day in India. I think Gautam, you've logged in from US. Is that correct?
Hi Vikas. Actually, I'm in India right now for a short vacation, so I'm recording from Delhi.
Okay, great. So it's a very special day. One is because it's a auspicious day and it's a Republic Day, and second, with me, I have my friend Gautam Baid with me on this show. So thank you so much, Gautam, for accepting our request on and decided and agreed to come on this show.
Sure. Thank you,
Yeah,
Vikas. It is a pleasure to be here.
yeah. Thank you. So as all of you know that at AIF and PMS Experts India, we run this show called Ask the Expert, where we invite industry experts or somebody who has amazing talent or intellectual property, I would say, and understand markets well. We kind of take the opportunity of inviting them. We try and read their mind. We ask questions on your behalf. An idea is to exchange ideas with each other, and try and learn something. So let me have the privilege of introducing Gautam. Gautam is a good friend. I remember we met for the first time at Berkshire Hathaway's AGM, and at Omaha. This was, I think, 2017, if I am not wrong. And Gautam was there, and there were very few Indians. There were about, I think, more than 35,000 people or 40,000 people came together in a stadium. It was a big stadium where both Charlie Munger and Warren Buffett, they were speaking as a speaker and talking about the growth of their organization and how has been the performance. And there were hardly 40 or 50 Indians, and Gautam was one of them. So I met him, and we had a great time. I kind of had a great time with him. Understood a lot that what is he doing at those days. He was trying to look out for a job in US and trying to become portfolio manager there in US. Of course, he was a portfolio manager in India by then, and he was also in the verge of writing book. So the best way to introduce Gautam is say that he is the author of this book called The Joy of Compounding. One of my favorite book. I think I would have not only read this 7 or 8 times. I have also kind of given as a gift to at least seven of my friends and told them, if you read this book, you will arrive in your life, you will understand the power of compounding. For example, one good thing that I like about this power of compounding is, if your portfolio today value is 1 crore and if it is growing at 25% year on year, so at the end of 10th year, this 1 crore becomes almost 10 crores. I'm talking about the indicative numbers. And in 20 years, this 10 crores becomes 20 crores. Sorry, 100 crores. Correct, Gautam? And then it is 1,000 crores after 30 years down the line. So that's called power of compounding. So we thought the best way to introduce Gautam is that he is the author of this book. And today we want to learn two things. One, what is called joy of compounding. And the other thing is what is called discipline of investing. So I'm not introducing him as a portfolio manager at small case. And he's already introduced is one of his strategy, which is doing very well. He talks about long term. We'll come to that second. But the best way for me as a friend to introduce him is he's authored a beautiful book, and this is helping a lot of individuals, investors, to understand the power of compounding, understand the meaning of portfolio management, understand that what is called machine learning, continuous learning, understand how to upgrade yourself, and understand how to create your long term wealth. So many congratulations, Gautam. You've done great job. This is the best way that you can contribute something to the society. So many congratulations from bottom of my heart.
Thank you for the kind words, Vikas. I hope to
You
add
are on
value to
mute, I
your
think.
audience today.
Yeah, I think we are not able to hear you.
Okay. Is the voice coming now? I can hear you clearly.
Better now. Okay. Gautam, the format of the show is very simple. What we're going to do is we'll be asking you a few questions, and then if you have anything else to add, please add. If you want to wish to put up any presentation, we would be more than happy to have it.
Sure. Let me just share my presentation with all of you.
Sure.
Just a second. Let me know if the presentation is clearly visible and my voice is audible.
Yeah, loud and clear, and the PPT is also very much visible. So my
Perfect.
first question before we start the discipline of investing, Gautam, what made you to write this beautiful book?
Well, the joys of compounding is basically my heartfelt tribute to all my teachers in life who helped me achieve financial independence, become a better and wiser person, and helped me embark on the path to a fulfilling and meaningful life. And writing about and sharing my life's biggest learnings was simply my way of giving back to the investing community from whom I've gotten to learn so much over the years.
Great. So there, the first thing that I saw when in the book is you talked about machine learning and you become wiser every day when you wake up. So can you throw some more lights on that? What is called self learning?
So basically, Warren Buffett often talks about compound interest, and Charlie Munger often talks about the virtues of lifelong learning. So when you combine both of these, you get what my book is titled, "The Joys of Compounding." More importantly, the subtitle, "The Passionate Pursuit of Lifelong Learning," because it's my firm belief that even the a person of average intellect, even with constant, basically a person of average intellect with constant effort and very strict and strong discipline can actually achieve wonders. And to succeed in life, you don't need to do exceptional things. You just need to do the basics very well, consistently, and then watch the power of compounding take over and do it and bestow its magic upon you. But be mindful of the fact that compounding will bestow its magic upon you only after testing your patience to the fullest. And the power of compounding is backloaded. In the first 5-10 years, you'll hardly see anything happening, but once you hit the inflection point of the exponential S curve, that is when the magic actually starts happening. That is what I'm experiencing in my life right now. Once you hit the exponential part of the J curve, that is when the magic starts happening. But before that, you need to exercise tremendous amounts of patience and discipline.
So in a way, can I say that you have to go through very difficult phase of or a painful area or a phase in your life when you really want to do something great? Is
You
that
have
correct?
to embrace a delayed gratification, resist instant gratification, and embrace delayed gratification. All the great things in life, be it your health, be it your intellect, be it your goodwill, be it your wealth, be it your knowledge, all of those great things will come from compound interest in the long term. So, and the best part about playing the long term game is that it's very less crowded. There's hardly anyone playing the long term game nowadays, especially in the age of social media, where all these people living as per the external scorecard, and the whole concept of comparative comparison based existence that's just becoming amplified in the age of social media. So the idea is to play your own game. The idea in the life is not to beat others at their game. The idea is to live life as per the inner scorecard and play your own game. And that is the true definition of success, in my view. To live life in your own way and to live life aligned with your values. To live a life aligned with your values and make it very meaningful and fulfilling. I think that is a life well lived.
Sure. I also see that you bring about more than 1.5 decades of experience on the table as a portfolio manager. And I saw that you also touched upon what is called portfolio management services in your book as well. Would you be able to throw some more lights, because there are few investors who have joined for the first time and they would like to know more from you? What do you think? What is your views about portfolio management services?
I think over time, as you gain experience in the markets, you realize that portfolio management, in essence, is all about risk management first and return second. Because once you protect the downside, the upside takes care of itself, and that's why at Survival Wealth Partners we have a very keen focus on endurance, durability, and sustainability. And because we understand how long-term compounding works, we are fiercely focused on protecting the downside for our clients. And I think that's the way to go in most areas of life. As long as you can avoid the foolish mistakes and just keep doing the basics well, you'll do fine. And one more very important thing I would like to mention here is that many people think of being invested in a single stock for a long time period of time as a virtue, but I often tell people it's not about being invested in a single stock for a number of years. That's important. What's important is that you remain invested inside the market in a portfolio of good stocks for a long period of time. Because what will happen is a good business does not necessarily mean a good stock. There'll be many instances during your career when a stock of a good business becomes outrageously expensive and the upside potential looks limited. So in those cases, even though the underlying business is good, you need to evaluate your holdings dispassionately and based on the potential for upside from the current market price. And even though it's a good business, you may have to sell it and replace it with a stock which has got good better margin of safety. So that's, I think, very, very important. Always think in terms of opportunity costs. As a portfolio manager, you have to keep thinking in terms of opportunity costs and think about whether your existing portfolio at a portfolio level can give you the desired rate of returns over the medium to long term. That's very, very important. Instead of getting anchored to the past purchase price of the stock.
All right. So after getting the confirmation from your end, the moment my team started inviting some of our investors, the first question which came in their mind is, when is Gautam starting his portfolio management services? And we saw some of the tweets also, going around. So first of all, I would like to congratulate you that you recently launched your portfolio, at small case. But any view that when are you planning to come out with PMS?
So after my initiative 6 months ago of chapter, then I started this small case, and now I'm working on setting up a India hedge fund in the United States, and it will cater to American citizens and green card holders. So that's going to keep me busy for the major part of this year, 2022. I may consider setting up a PMS later in India after that, but for now I'm very, very busy with setting up the India fund in the US, because I'm a very big believer in the India opportunity. I very strongly believe that the opportunities in the next 20 years in India will be far greater and superior than the opportunities of the previous 20 years. And I'll talk about that in the presentation today as well. And I really wanted to bring this India opportunity to investors in America. So I've already met a few prospective clients in December. I traveled to Silicon Valley, California. I met up with a few prospective clients. The initial response has been very, very good and enthusiastic. And what I'm very happy about is that I'm designing this fund. It will be modeled after the original Buffett partnership, zero management fee. And over the last 12 months, I was basically working on how to make this fund very, very client centric. Because, like I said, we want to play the long term game with long term minded, like minded people, right? So I basically, just like my small case, I wanted my investors in the India fund to self select themselves. Only those investors who want to basically be long-term partners, they self-select themselves. They themselves who understand my philosophy, they approach me that they want to get uh, associated with this particular fund, invest in it for the long term. I think that's the way to live a very happy and peaceful existence as a fund manager. And uh, people who have attended my second chapter, the fourth and final week of the second chapter is actually titled "Positioning for Longevity as an Emerging Manager in the Investment Business." And basically, I've implemented all the key principles from that particular module of that chapter into this particular fund. And basically, I wanted to walk the talk. It's not just enough to share theory; you have to actually implement the same in real life as well.
Absolutely, absolutely, and great that congratulations you've started this advisory business. And there are a lot of people who might be interested, and they were asking me, can you talk to us about your chapter also? If suppose I am the investor and I wish to be a part of it, how do I join? What do I have to do?
So you can log into getchapter.app/Gautam, and it's a 3 chapter series of 4 weeks each. It's a curation based learning platform, and the idea is to take you from beginner level to expert level in just a matter of those 3 chapters spanning over 12 weeks in total. And it's more of an accelerated learning program. And the whole idea behind chapter is to curate and provide you the best and greatest content on the internet on any given subject matter. So in my case, I've taken up the subject of investing. And uh, for the last 15 years, I've always had this personal habit of curating content and just bookmarking my favorite content. I never thought it'll help me 15 years down the line in the form of chapter. But again, this is again a compounding in action. All those 15 years of reading and collecting all this information, finally, when the opportunity came my way, I was more than happy to join the founders of chapter, Kyle and Steve, on their mission to make highly specialized education very affordable and accessible to all the learners across the world. So far it has got a very good response in the first 6 months, and I think over time, as the awareness about chapter grows, I think we'll make it into a very big community of like-minded lifelong learners.
Okay, so we'll come to the topic. We can start the presentation. And over to you, Gautam. All yours.
Sure. So, hello everyone. Very happy Republic Day to everyone attending the presentation today. Today, I'll be speaking about the discipline of investing. Standard disclaimer before I begin. This presentation is solely for information and knowledge sharing purposes, and all the stock examples shown are for understanding concepts and should not be considered as stock recommendations. Stellar Wealth Partners is a SEBI registered research analyst firm, and we may hold some or all of the discussed stocks from this presentation in our proprietary accounts or small case model portfolios. It is also possible that we may have exited or may exit from these stocks in future without prior notification. So please do your own research and due diligence for any investment actions and consult a registered financial advisor for the same. And most importantly, the views expressed are my own personal views and do not represent the views of any entity or organizations. This is the statutory disclosure as per the SEBI guidelines for all the corporate research analyst firms. So just take a moment to kindly go through it. I think the most important point is actually in the first one, that uh, the research analyst and the research entity, that is relevant partners, we may own or may have owned in the past some of the stocks discussed in the presentation.
Yeah, and want to add one more point here. The disclaimer is that please do not invest just because this idea is discussed in the presentation. You please consult your investment advisors or you speak to us. Over to you.
So this will be the flow of today's presentation. I'll be taking everyone through my investing framework, demonstrate the same through the use of case studies from the Indian stock market, and I'll conclude with a brief about how value investing resembles a life discipline. So all the great investors in the world have one common characteristic. They all have a clearly defined investment philosophy. And that investment philosophy, in turn, is defined by their personal experiences, vicarious learning from other people, through books. In my case, these are the books that have defined my personal investment philosophy. Terry Smith's Investing for Growth taught me how to invest in high quality businesses for the long term. A Capital Returns, edited by Edward Chancellor, taught me how to invest in cyclicals and commodities using the capital cycle approach. And Joel Greenblatt's You Can Be a Stock Market Genius taught me how to evaluate various special situations like demergers, reverse mergers, and other special situations. This is a brief snapshot of my investment process flow. At any particular point of time, I have a list of existing ideas for which I keep tracking their performance, and I keep taking feedback on the management and the business. And to that existing watch list, new ideas are added from time to time through an idea generation process. And finally, I come to an active watch list of 10 to 15 high potential opportunities. That in turn feeds into my portfolio construction and portfolio tracking and rebalancing process. Let me talk about the portfolio construction and tracking rebalancing part first. My portfolio on an average comprises of 20 to 30 stocks. The reason for this broad range is that in a bull market, when you get earnings expansion across sectors, the number of opportunities goes up a lot during a bull market. So the number of holdings for many investors tend to go up during a bull market because you have got broad-based earnings growth. And during bear markets, when the earnings growth dries up, you end up with a concentrated portfolio because the number of companies having good earnings growth is very limited. The aim is to generate 20 to 25% CAGR for the portfolio over a minimum holding period of 3+ years at any point of time. And I follow a sector and market cap agnostic investing approach with a bias towards under-researched and well-run small to mid-cap companies. There is no hard cap on the contribution to the portfolio from any one single idea or sector or market cap range, but prudence is maintained at all times. The weight per stock ranges from 3 to 5% at the time of purchase, and the exceptional opportunities may get an allocation of even up to 10% at cost. The decision to exit any investment will solely be based on their business performance or their potential incremental IRR or internal rate of return. A portion of the portfolio is kept in cash if the valuations of existing holdings and the watch list become exorbitant. We don't go into cash based on our prediction of any macro event. It's completely a bottom-up approach. As far as portfolio tracking goes, I track the industry trends of all the portfolio companies, like changes in competitive landscape, technological updates and changes, government regulation changes, any supply chain disruptions. The quarterly results of each company is evaluated against my own expectation, and the performance is benchmarked against that of competitors. A detailed diligence is carried out in case the investment's performance is not as per the initial investment hypothesis. Finally, we come to portfolio rebalancing. An investment is sold if its valuations become absolutely expensive or if there is a structural challenge to its business fundamentals. The portfolio companies are periodically ranked based on valuations, earnings performance, expected future stock returns, and the rebalance is done accordingly. And a fresh or follow-on investment in an idea is done only if it can deliver an attractive IRR over a period of the next 3 years. Now we come to the crux of today's presentation about how do I go about generating new ideas. This is a very common question that I keep getting all the time, that how do I generate new ideas on a regular basis? What is the idea generation process? This, in brief, is the snapshot of how I source my ideas. So every day, I diligently review all of the corporate announcements on the Bombay Stock Exchange website. And it's a painstaking exercise for many, but for me, it is like an intellectual treasure hunt wherein I may strike gold anytime. And every day, I'm creating numerous opportunities for serendipity and good luck to find me. I review press releases, investor presentations, M&A deal, joint venture partnership agreements. When I'm evaluating quarterly results of companies on my watch list, I'm looking out for breakout earnings. So what does breakout earnings refers to? It refers to situations where a particular business is experiencing sales growth of more than 50% year on year, earnings per share growth of more than 100, 200% year on year. And in those cases, the stock market is generally a bit slow to adjust the stock price of those companies to the right, to the correct higher level. They take some time to actually adjust the stock price to the right higher level. So in these cases, you get what is known as PEAD, post earnings announcement drift. So even if you buy those stocks 5-10% higher the next day after those blockbuster earnings, you still end up making very good returns even after that. I try to attend the conference calls of all my existing holdings and watchlist companies on websites like Trendline, Alpha Street, Research Bytes. Even the company website investor relations section is a good source, especially for micro caps. A peculiar problem with many promoters in India is that they tend to be overly bullish during the good times and overly bearish during the bad times. And it's very important to corroborate and cross-check what they are saying with what their global peers are saying. What is the commentary and outlook being given by the global peers? I try to attend the management interviews of the companies that I'm tracking on in print and digital media. As far as screening tools go, I use screeners like Tejuri Finance and Screener.in. Tejuri Finance is very good for tracking commodity and chemical prices, and Screener.in is good for tracking companies which are either undergoing a very big Capex program or which have recently completed a very big Capex program. You can also get through the screening tools the list of stocks hitting 52-week high, all-time high, post IPO new high. Now, what do I refer to when I'm saying post IPO new high? In case of many of the new listings after the initial listing pop on the listing day, many of these stocks tend to go into a long-term consolidation for 8-10 months or more. And once they break out to a new high after that long-term consolidation, it generally coincides with some important development taking place in that particular company. So look for stocks which are hitting a post IPO new high after a long time period consolidation. As far as equity research reports go, I like to read reports issued by Ambit, ICICI Securities, Spark Capital, India Infoline, Nirmal Bang, and Axis. I read the annual reports, credit rating reports, the draft red herring prospectuses and QIP offering documents of the companies that I'm tracking. The prospectus and the QIP offering documents in particular are a very good source for rich detail on the underlying industry. So, for instance, if someone wants to understand the economics and the dynamics of the music licensing industry in India, they can read the recent QIP offering document of a company named Saregama Limited. I also read the investor letters of fund managers whom I admire and respect. So I like to read letters written by Solidarity PMS, Sage One, Equirus. I try to attend the investing conclaves like Tamil Nadu Investor Association, India Investing Conclave, and webinars like those provided by SOIC are also a good source for idea generation. A less talked about source for idea generation is fund managers top 5 holdings from PMS Bazaar website. So the sign up is basically free, and you can actually get a look into the top 5 holdings of the fund managers whom you like and respect, along with their allocations as well. So this is a less talked about source, but it's a good source for idea generation. I also review the bulk deals, block deals, and insider buying data on a daily basis. Stockage app does a good job at this. The 52-week high volume list is also a good source for idea generation, because if the stock of any business is experiencing a 52-week high volume, it generally tends to coincide with some important development taking place in that business or the underlying industry. For magazines, I like to read Fortune India, Forbes India, and Outlook Business. And as far as newspapers go, I like to read the Economic Times and Business Standard. I also go through industry specific websites. Like for chemicals, I look at Chemical Weekly. For steel, I look at Steel Mint. For commodities, I look at Platts.com. Apart from this, I also have daily ongoing discussions with my peers and colleagues in the investment profession, and I also look for the views of the leading analysts of individual sectors. Finally, we have got social media platforms like Twitter, WhatsApp groups, Telegram channels, and online forums like Value Picker and Multiply. Now, I ask all our listeners today one simple question: that if you go through all these sources on a daily basis for the rest of your investing careers, how can you not be simply flooded with great opportunities all the time? In the stock market, if you put in the hard work, you'll get disproportionately rewarded over time. But in the stock market, there is no alternative to hard work. And in life, business, investing, nothing will work unless you do. And there is no reason for you to settle for an inferior track record in a marketplace like India, which is filled with companies and stocks having outstanding fundamentals. This is one of the most important slides in today's presentation, and it is something which I'll keep referring back to again and again, which is that the key attribute of great investors is a relentless focus on the underlying process. And I've talked about the same in my book as well, and I quote: numerous research studies have identified a common trait among successful professionals in fields of probabilistic activity. They all emphasize process over outcome. If you focus only on the outcome, you are less likely to achieve it. Instead, if you focus on adhering to a sound process, the outcome will take care of itself in the long term. Although the short term results almost always will be driven by luck. Over the long run, a sound process can be counted on to deliver desirable results in a sustained manner and produce more reliable outcomes. And Michael Mauboussin has spent some gems on this topic in the past, and I'll quote him: in a probabilistic environment, you are better served by focusing on the process by which you make a decision than on the outcome. We have no control over outcomes, but we can control the process. Of course, outcomes matter, but by focusing our attention on process, we maximize our chances of good outcomes. This is the key for investors. This is the best that all investors can do. The only thing in our control is the process. And because investing is a probabilistic activity, what that means is even after following a sound process, the outcome may not always be favorable. Even after following a sound process, you may end up incurring a loss on a stock. But on average, over a long period of time, you'll end up being successful, because in all fields of probabilistic activity, over the long term, skill and process wins. In the short term, the outcomes are driven by luck. I follow a multi-pronged approach for idea generation. I track key company metrics like leaders in niche sectors with low competition, having healthy balance sheets, high returns on capital employed, and good revenue growth. I track the investment activities of private equity funds, hedge funds, and mutual funds. I also look up to the views of respected individual investors who I admire and respect. Insider buying data is also pretty important. I track the industry developments as well. For instance, sectors undergoing supply side consolidation. A good example here is the Indian real estate industry, which has undergone a massive supply side consolidation in the last 10 years. I'm also on the lookout for any favorable or unfavorable regulatory changes, because this can be a big driver of alpha generation. And I'm also on the lookout for emerging sectoral adoption trends. Here, a very good example is how we consume music. So, in the old days, we used to consume music through audio cassettes and CDs, but today, music streaming is basically the way we consume music. So we make use of music streaming apps like Spotify, Savan, Ghana, YouTube, etc. But one of my favorite ways for generating alpha is through tracking corporate events, namely change in promoter and management, block deals, merger arbitrage, demergers, and companies having completed a significant capex. So let's have a look at a few case studies in each of these areas. So this is the first case study based on promoter and management change. So in August 2020, the stock of CG Power was trading at sub 10 rupees. The stock had been hammered out of shape because the previous year in 2019, the company had been hit with a 3,000 crore rupee fraud. In August 2020, entered the Murugappa Group from South India, a group known for stellar standards of corporate governance. And ever since the acquisition of CG Power by Murugappa Group in August 2020, the stock of CG Power has given more than 1500% returns already. So when a company with low perceived standards of corporate governance is taken over by another company with very high stellar standards of corporate governance, you get massive value creation and you end up having big multi-baggers. Now, this was a past example which has played out in a big way. Let's talk about a live example from the current market. So, in August, in 2020, you also had Embassy Group announcing the merger of Indiabulls Real Estate with itself. And what's going to happen here is the erstwhile promoters of Indiabulls Real Estate have already sold out all their holdings. Now the promoter holding of the erstwhile promoters has basically come down to almost zero. What's good? And now only the shareholder meeting and the NCLT approvals remain. Once the merger gets completed, you'll get multiple catalysts for re-rating. And like I talked a few slides earlier, investing is a probabilistic activity and it's all about getting the odds on your side as much as possible to the maximum extent possible. You want to stack multiple layers of positive probability events on your side. So what are those multiple layers of positive probability events in this case? First, once the new promoter Embassy Group takes over, you'll get a valuation re-rating because of the corporate governance premium, number one. Number two, Jitendra Virvani will be who's the chairman of the Embassy Group. He'll be the new promoter and he enjoys a very high reputation in the Indian real estate circles. So for his leadership premium, also you'll get valuation re-rating. And finally, the residential real estate cycle in India has entered an upturn after almost a decade. So you'll get the alpha generation from there also. So you're getting multiple positive forces working in your favor. All that you need to do now is have patience and just let the merger play out and then hold on until and enjoy the upside from the ongoing and upcoming real estate upcycle. The next source for idea generation, which I talked about, was block deals. Now, sometimes in the stock market, you'll notice that even after a blockbuster quarterly earnings report, the stock price does not react. In fact, it goes sideways, or in fact, it even declines at times. And many investors are perplexed as to why this can happen. How can this happen? It may so happen that there is an institutional shareholder who's trying to exit from the stock, and it may be for any technical reason. For example, the fund manager may be facing a redemption request, or a new fund manager may have joined the fund and he does not like this particular stock, he just wants to sell it. The reasons may be anything, any random reason, any technical reason, but as investors, we are focused on the value of the underlying business and the potential for returns from the current market price. And whenever someone sells in desperation, they tend to sell cheap. And as a buyer, I love to be on the opposite side of such trades in which the other party is being forced to liquidate holdings at any price, regardless of underlying value. This is a special situation. So on 15th June, it was reported that Templeton Strategic Emerging Markets Fund had sold 2.36 lakh shares of Global Spirits at 430 rupees per share. And once the selling pressure got absorbed, and once this particular institutional investor was out of the stock of Global Spirits has given almost 300% returns in the last 6 months. And why did I mention this particular block deal specifically? It's because this block deal coincided with a blockbuster quarterly earnings report of Global Spirits. So you keep having block deals and bulk deals on a regular basis in the stock market, but to generate that massive alpha, you want to look for block deals which are taking place immediately after any particular company has reported a blockbuster quarterly report, because that is when you'll get what is known as a coiled spring. The earnings have exploded, the stock price is stagnant, and you are holding a coiled spring in your hand, which will just bounce back in a very big way once the selling pressure from the big institutional shareholder is out of the system. The next source for idea generation and alpha generation is merger arbitrage. So Under the pen name Cogitator, Benjamin Graham had written several articles for the Analyst Journal, and he penned a seminal article on special situations in the fourth quarter 1946 issue, in which he wrote, in the broader sense, a special situation is one in which a particular development is counted upon to yield a satisfactory profit in the security, even though the general market does not advance. In the narrow sense, you do not have a real special situation unless the particular development is already underway. And Graham concluded the article by summing up the essence of a special situation as an expected corporate development within a time period estimable in the light of past experience. Early last year, on January 24th, 2021, I tweeted about a merger arbitrage opportunity in Harita Seating. So, Minda Industries was about to merge Harita Seating with itself at a 1.52 to 1 merger ratio. Now, for all the advocates of efficient markets, just look at what was happening. For every single shareholder of Harita Seating would get 1.52 shares of Minda Industries, whose stock price was trading at 508. So, as a shareholder of Harita Seating, you would get 508 into 1.52, which is equal to 772 worth of shares of Minda Industries. But the stock price of Harita Seating was 534. So you could have simply made 40% returns in a matter of few months just by patiently holding onto your stock and doing nothing. On 4th February, Minda Industries reported a blockbuster set of numbers for the quarter. And because of the merger ratio of 1.52 to 1, for every 10% up move in Minda Industries stock, as an investor in Harita Seating, you would enjoy 15.2% capital appreciation because of the way the merger ratio was structured. And this was a special situation in which a patient investor would get paid just for waiting. The very next day, 5th February 2021, the merger came one step closer to completion and only the Chennai NCLT order remained pending. The merger finally got completed on 9th April 2021, and the stock of Harita Seating was delisted from the stock exchanges at a price of 766. So, from a price of 534 of Harita Seating on 24th Jan to a price of 766 of Harita Seating on 9th April, you could have basically made 40% returns in just 2.5 months by taking advantage of the merger arbitrage at play. Now, having understood how a merger arbitrage works in the stock market, I would like to now highlight two live examples of merger arbitrage in the market as we stand today. So in February 2021, APL Apollo announced the merger of Apollo Tricoat with itself at a 1:1 merger ratio. And in July 2021, Equitas Holdings announced the merger of Equitas Small Finance Bank with itself at a 2.26 to 1 merger ratio. Just check the stock prices of these four companies today, as they stand today, and see if there is any potential for merger arbitrage. The next source for idea generation is that of companies having incurred a significant Capex. So let's have a look at this particular company. This is a snapshot of a particular company from Screener. And as you can see, from March 2021 to September 2021, the gross block of this company, the fixed assets, have more than doubled. And it's a pretty well managed company. In 2018, they generated ROC of 33.4%. In 2019, they generated ROC of 28.28%. In March 2020, they generated ROC of 29% plus. But in the latest financial year, March 2021, they incurred a small loss. Now, if you were using just simply using a mechanical screener and putting one of the criteria as net profit more than zero, you would end up missing such opportunities. In these cases, you simply have to dig deeper to see why such an efficiently managed business reported a loss all of a sudden in the latest financial year. In this case, it was because this company shut down their existing plant for 4-5 months to synchronize with the new plant which had been set up, and as a result, they did not generate any revenue from their existing plant for 4-5 months, while they kept incurring the fixed costs. That's why they ended up reporting a small loss for the year. But now the new plant has been fully integrated, and now the sales and profits from the new facility will start showing in the numbers. So this is how you get such opportunities in the stock market. The stock of this particular company has already fallen 50% last year from the 52-week high, and it was available at a very low market cap and at a very depressed valuation. Now it has recovered to a large extent, but there was a time where because of the short-term loss reported by the company, the investors in the market just dumped the stock, and or offering it to investors like us at a very cheap price. So focus on value. Price is basically more of a distraction in the stock market. You have to just keep focusing on value, because in the very long term, the stock prices converges with the earnings growth and the growth in free cash flow of the company. You will always take one of these four risks when you buy a stock: business risk, management risk, valuation risk, industry risk. And there are only four things that can happen in investing: a big profit, a big loss, a small profit, and a small loss. And if you can eliminate the big losses, you shall do very well. There is no bigger mistake in investing than holding on to your losers for a long time. Going wrong occasionally is perfectly acceptable, but staying wrong after even after realizing your mistake, that is not acceptable. And how can you eliminate the big losses in the stock market? You can eliminate the big losses in the market by avoiding certain things. And there are certain things which I strive to avoid as an investor, both for myself and for my clients at Stellar Wealth Partners, namely investing in commodity and cyclical businesses near the peak of their cycle, investing in government owned companies because the promoter scheme motivation is not wealth creation for shareholders, it's for doing societal good, investing in project based businesses dealing with government tenders, investing in melting ice cubes, or what I call value traps. These are businesses which look optically cheap, but they will remain cheap and will become even more depressed in terms of earnings over time because the underlying business is in structural decline. So a good example here is the newspaper stocks in India. They have always looked cheap for the last many years, and they'll remain cheap as we keep there's a value migration going on towards digital media consumption. I avoid venturing outside my circle of competence, driven by the lure of quick short-term returns in bull markets. It's very important not to let your guard down during bull markets, because the mistakes of the bull market are realized only in the subsequent bear markets. But it's only after going through the pain of a few bear markets that investors mature and realize the importance of not going down the quality ladder during the fag end of a bull market. A very big problem with many companies in India is that they have bad accounting quality or corporate governance issues. And many people tend to ask me, how do I evaluate the quality of the managements in the businesses that I invest in without meeting them? It's through use of a comprehensive corporate governance checklist. And I check for any frequent change in auditors, any qualifications raised by auditors. Are the auditors earning any abnormal fees? Is the auditor fees growing faster than revenue growth? Does the company have many unaudited foreign subsidiaries with it? Does the promoter have any political affiliations or criminal proceedings against him? Has the company been subject to any CBI, Enforcement Directorate, or IT raids in the past, or any instances of SEBI debarment? What is the history of resignations and attrition in the C-suite or the management suite of the company? Is the key management personnel drawing excessive remuneration or blowing large sums on building a lavish corporate office? Has there been excessive equity dilution? Is the promoter pledging his shares? Is the promoter holding coming down? What is the history of the company in terms of sharing wealth with the minority shareholders in the forms of dividends and share buybacks? What are the credit rating reports saying? Are there any related party transactions taking place in the company? If so, are they very significant? What is the view of current and ex-employees of the company? You can get this information on websites like Glassdoor. What are the industry experts saying about the company? What are reputed investors saying about the company? Does the promoter have a similar business as the listed entity in his private company? Because that may lead to a conflict of interest. I also check for the quality of the accounting followed by the company. So when I say evaluation of accounting quality, I'll give a few examples here. I check for volatility in depreciation rates because the depreciation rate can be easily modified by the management to manipulate earnings. I check if expenses have been directly written off from the balance sheet against reserves and surpluses instead of being routed through the profit and loss statement, thus inflating profit. I check whether the company is following a very aggressive revenue recognition policy, because they may be wanting to front load the revenues and capitalize the expenses to basically paint a more rosy picture during bull markets. Is the business very working capital intensive? What is the trend of accounts receivables and inventory days? What is the trends in historical cash flow from operations to profit after tax ratio? Because this tells me how much of the reported earnings are being converted into cash flow from operation. One more good ratio is cash flow from operations to EBITDA ratio. That's also very commonly used by many investors. If any company in a commodity industry is enjoying abnormally high margins versus its peers, then that's something which should make you sit up and take notice. It's not normal for a commodity company to earn 30% margins while its other commodity peers are earning 10% margins. So do a deep dive in such instances. Also check whether the company has engaged in an excessive write-offs of its assets in the past. Does the company capitalize its operating expenses? So a good example here is the Indian pharmaceutical industry, in which the research and development or R&D is a very common line expense item, but some promoters tend to capitalize their R&D to smooth out their earnings. So that's very aggressive accounting. And I like to prefer managements which are more conservative in their accounting, which expense out the entire R&D in their profit and loss statement in the year it is incurred. I check for trends in the debt to equity ratio, whether the company has engaged in any statutory payments default in the past. Does the company have any high contingent liabilities? Does it also have any off balance sheet obligations? For example, is there any guarantee given by the promoter on its group entities through the listed company? Now, some people may ask, what's the need to do all this hard work? Who looks at balance sheet and cash flow statements in a bull market, let alone footnotes to the accounts? The answer to that is that when you're in a position of fiduciary responsibility and you're advising families and individual working professionals on investing their hard-earned savings and their hard-earned money, then you owe it to them to reciprocate their trust in you. And following this particular corporate governance checklist from this slide actually helped me avoid including a particular stock for my flexicap small case a few months ago. It was a specialty chemicals company catering to the textiles industry, and the promoters were constantly coming on business television channels and giving very rosy, painting a very bullish picture. They were also announcing very high profile tie-ups with foreign companies, but one deep dive into its latest annual reports and there were red flags galore. And even though the stock is hitting a fresh 50-week high recently, but my past experience tells me that these sins committed by companies and promoters during a bull market eventually catch up with them during the subsequent bear market. So I just want to stay away from such companies, and I'm happy to forego some short-term returns from such companies and rather focus on healthy and good returns from companies which have got negligible corporate governance concerns. Another very important thing that I strive to avoid as an investor is to take a short-term view, because investing is a long-term game, and the more time you give it, the higher the odds of success. And why do I say this? It's because in the short term, any period less than 1 year, almost half of the stock price movement is driven by the valuation multiple, which in turn is driven by the sentiment among investors. So in the short term, the stock prices are largely driven by changes in sentiment. But over the long term of 10 years and more, almost 90% of the stock price movement is explained by sales and profit growth. And in the seminal piece on valuation, which is titled Valuation, Measuring and Managing the Value of Companies, the authors write, and I quote, we have found empirically that long-term revenue growth, particularly organic revenue growth, is the most important driver of shareholder returns for companies with high returns on capital. Traditionally, there have been three sources of edge for the individual investor. Initially, there was what is known as the information edge. This used to exist in the early 1950s and 60s, but with the advent of the internet and widespread dissemination of information, the information edge is basically gone. The second source of edge traditionally for the investor has been the analytical edge. But with more and more smart people entering the investing profession, even the analytical edge is fast getting compressed. But the one edge, which in my view is the most durable and sustainable, is that of behavior and temperament. Shane Parrish of Farnham Street blog writes, and I quote, people who arbitrage time will almost always outperform. The first order thought of instant gratification is a crowded path, ensuring mediocre results at best. Delayed gratification, which requires second order thinking, is less crowded and more likely to get results. In a similar vein, Howard Marks writes, and I quote, rule number one, most things will prove to be cyclical. And rule number two, some of the greatest opportunities for gain and loss come when other people forget rule number one. 50 years ago, the best investors were the ones with an informational edge. Today, the best investors are the ones with a behavioral edge. As the speed of information dissemination in the markets and competition for short-term outperformance among money managers increased over the years, time horizons and patience levels significantly decreased. Today, an investor's edge is less about knowing more than others about a specific stock and more about the mindset, discipline, and willingness to take a long term view about the intrinsic value of a business. And I've talked about this in elaborate detail in my book's chapter on delayed gratification. And I would like to quote an extract from that particular chapter, that investors generally overlook businesses that are doing things that will create significant incremental earnings 1 to 2 years from now because they don't want to wait that far out. And investors often shun businesses that are investing for the future and currently are suffering from low initial margins in those new initiatives because capacity gets utilized only over time and the earnings growth is back ended. Even if they execute well, they will see little reported earnings growth for the next 4 to 8 quarters and may even see a decline resulting from incremental depreciation and poor initial margins. And even if they are expected to experience an exponential jump in earnings growth after that, the stock markets generally do not initially increase the market value of these businesses. They do re-rate them, however, around the time when the earnings growth is clearly visible. As investors, we get an edge over competition if we pick these companies and have the patience and conviction to hold them. Although these businesses are clearly undervalued on a longer term basis, it is psychologically challenging to invest in them and even more so to hold on to them. And these difficulties result in a lack of investors and the subsequent mispricing of these stocks because the price discovery is weak when investors' attention on these stocks is low. Let me illustrate this with the help of a personal example. So during 2018 and 2019, the Indian auto industry was experiencing a down cycle after the NBFC crisis. And there was an auto ancillary company named Rajratan Global Wire, which was undergoing a very big capacity expansion program. Because the entire auto sector was out of favor, the investors' attention on this particular stock was low. But as soon as the capacity expansion got over and the earnings visibility went up post a recovery in the auto cycle, the stock of Rajratan Global has given more than 1000% returns since April 2020. And this is deep value investing at its finest. You want to ride such capex plays through the full industry cycle, invest in them when the industry is undergoing a downturn because you get to buy them at low valuation and low market caps. And then you patiently hold on to them through the full industry recovery up to the peak of the upturn, and then exit in a timely manner to reap maximum capital appreciation. So when you invest in these companies during a downturn, just check their balance sheet, whether they can actually survive another 1 or 2 years of the industry downturn. And then just stay put and be patient. Like Howard Marks said, rule number one, most things will prove to be cyclical. But more importantly, rule number two, some of the greatest opportunities for gain and loss come when other people forget rule number one. Successful investing is all about pattern recognition. Just a few slides ago, recall what I'd said, that the stock markets generally do not initially increase the market value of these businesses. They do re-rate them, however, around the time when the earnings growth is clearly visible. On 10th January 2021, I tweeted about a company named Ultramarine Pigments, which had completed a big capacity expansion and was trading at low valuation. And my thesis was that earnings growth coupled with margin expansion should now lead to P rating because the new capex for this company had been done in the higher margin business of surfactants. And since 10th January 2021, the stock of Ultramarine Pigments has given more than 40% returns till date. So I had mentioned that successful investing is all about pattern recognition. So much so that in my book I've devoted an entire chapter to pattern recognition, in which I've shared the various catalysts for re-rating through the use of management and market signals. And let me quote from that particular chapter. Along with the slow and gradual macro changes, investors should also be alert to tiny changes at the micro level. Be alert to tiny changes like the declaration of a maiden dividend, receipt of a large order or a landmark contract, appointment of a Big Four auditor, increased or first-time disclosures or discussion about business prospects and future plans in annual reports, presentations, or press releases, a chairman of or a CEO of a listed company sharing business commentary for the first time, a company holding an analyst or investor conference call for the first time or after a long time, an upgrade of a company's debt instruments by the rating agencies, a sudden increase in the market value of a company's bonds because bonds are more sensitive than stocks to changes in the economic fortunes of a company, or notable improvements or deteriorations in the working capital cycle. Always monitor the direction of the quality of earnings. And such an elaborate and exhaustive exercise requires total dedication on part of the investor, but it is highly rewarding. So one of the patterns I just discussed was about always monitoring the direction of the quality of earnings. And why is that so important? Because in investing, one should always focus on delta, that is on the rate of change in earnings growth and its underlying quality. Warren Buffett has very aptly said that a business should be viewed as an unfolding movie, not as a still photograph. Refer to this particular screenshot from the annual report of a company in India. It's a pretty old company. It was incorporated in 1919. And from 1919 to 2005, they were in the fertilizer business. In 2005, they shut down the fertilizer business and started manufacturing low margin bulk chemicals. And from 2011 onwards, they have shifted their focus to high margin specialty chemicals business. Earlier last year, on 10th February 2021, this company came out with a detailed outline on its Capex plans. And as soon as the visibility of its earnings went up among the investor community post the release of this particular presentation, the stock of Dharamsi Moraji Chemicals has given more than 50% returns since that particular date. So that was the first pattern about monitoring the direction of the quality of earnings. The second pattern, which I would like to discuss now, is increased or first-time disclosures or discussions about business prospects and future plans in annual reports, presentations, or press releases. So in the early part of the presentation, I talked about the various sources for idea generation, and I talked then about how working hard today will help you find good luck in future, and how I review the BSc corporate announcements, the press releases, and the investor presentations on a daily basis. This is on the right hand side of this slide. You can see a screenshot from the investor presentation of a microcap company on which was released on 1st of November 2021, just 2.5 months ago, in which they mentioned about a 96 crore capex at 3x asset turn, which means that they would generate 300 crores of additional revenue from their capex, and this capex would go live by second quarter of FY23. So within a span of less than 2 years, the company was talking about quadrupling its revenues, because the trailing 12-month revenues of this company, as you can see here, was 101. So from 100, they would basically go to $400 of revenues, quadrupling of revenues. And since 1st November 2021, the stock of natural capsules has given more than 150% return already. So that was the second pattern. The third pattern, which I would like to discuss today, is that of receipt of a landmark contract. So in early 2020, Navin Fluorine had won a 2,900 crore order in its high performance product business. And since that particular date, receipt of that particular large order, the stock of Navin Fluorine has given almost 140% returns since that particular date. Now, it's very interesting to understand what has happened here. Out of the 140% stock price returns of Navin Fluorine, almost 100% out of that 140% stock return has come from P re-rating. So if you see, the P of Navin Fluorine basically got re-rated from 40 to 80. So 100% out of the 140% stock price returns came from P re-rating. Now we need to understand as investors, why did this P re-rating take place? Why did the P ratio of Navin Fluorine double? And for that, we need to understand the art of valuation. To be a successful investor, you don't need to do a precise DCF calculation on a spreadsheet. Not at all. You just need to have a DCF mindset, focusing on the drivers of terminal value, which in turn drives multiple re-rating and de-rating. Be a business analyst, not a securities analyst. And intelligent investing is all about understanding intrinsic value. So let's go back to first principles. The intrinsic value of an asset is the sum of the cash flows expected to be received from that asset over its remaining useful life, discounted for the time value of money, and the uncertainty of receiving those cash flows. Valuation is an art form. Determining the present value of all the future cash flows of a business involves looking at the various aspects of a business's DNA, including its capital intensity, business model durability, balance sheet strength, profitability, competitive position, future growth prospects, and management bandwidth, among other factors, all weighed and compared with the current price. Some businesses are easier to value than others. Predictability of cash flows is an important factor. In other words, it is easier to value a business with stable operations and cash flows than a business with high volatility in its underlying operations every year. And less predictable cash flows need to be discounted at a higher rate. And why is that? Now, I'm about to cover a very important aspect of valuation, so please pay attention. In the previous slide, I mentioned that the intrinsic value of an asset is the sum of cash flows expected to be received from that asset, discounted for the time value of money, right? And the uncertainty of receiving those cash flows. What drives that discount rate? It is the risk perception of the cash flows, which drives the discount rate. And the discount rate in turn drives the valuation. The market places a heavy weight on certainty, and stocks with the promise of years of predictable earnings growth tend to go into a long period of overvaluation until such time that they are no longer able to grow earnings in a steady manner. Predictability of long-term growth matters more to the market than the absolute rate of near-term growth. So a stock that promises to grow earnings at 50% for the next few years with no clarity thereafter is given a lower valuation multiple by the market than a stock that has slower but highly predictable growth for a much longer period. Consistent growth increases valuation, and consistent disruption decreases valuation. And the longevity of growth is always given a greater weight by the market than the absolute rate of growth. So you will often notice stocks with 12 to 15% predictable earnings growth for the next 10 to 15 years, getting current year P multiples of 40 times to 50 times. This phenomena perplexes most new investors, but with experience, they come to appreciate the finer nuances of the market and respect its wisdom. The expensive, high quality secular growth stocks tend to remain at elevated valuations for extended periods of time because investors in such stocks generally are willing to wait out periods of high valuation until earnings catch up. And markets provide disproportionate rewards to companies that can provide years of sustainable earnings growth. Why so? It's because longevity of growth is becoming increasingly scarce in today's world, which is characterized by a rapid pace of change. Fewer than 12% of the Fortune 500 companies from 1955 were still on the list 62 years later in 2017, and 88% of those companies had either gone bankrupt or had merged with or had been acquired by another firm. And this is Joseph Schumpeter's creative destruction at its very finest. Companies which have got higher longevity and higher duration of cash flows, by definition, have got higher intrinsic value. Again, I come back to the very important point which I mentioned, that it is the perception among investors regarding the riskiness of the cash flows of a business which drives the discount rate which they use to value that business. That in turn drives the valuation multiple. So I'll give you a good example here. So recently, after Saregama completed its 750 crore QIP, and once the management clarified in the conference call that the entire QIP proceeds would be used for developing the music licensing business and not a single rupee would go towards the loss-making Carvaan and film production business, the valuation of Saregama Limited, which was already re-rated, got further boost and got further re-rated because the risk perception among the investors regarding the cash flows of the business went down even further after the clarifications. That led to a further bump up in the valuation multiple. Similarly, there is a company, it's not a stock recommendation, and we do not hold it in our small case portfolios or proprietary accounts. There's this company called Solar Active Pharmaceuticals. Today, the company gets a very low valuation multiple because of its high dependence on the commodity ibuprofen business. But over time, if they manage to scale up their CRAMS business and scale up the non-commodity part of the business, you will notice that the risk perception about the cash flows of the business among investors will improve, and that will help lower the discount rate, and the valuation multiple for that business will again go up. So you have to just focus on where the puck is going, not where the puck has been. You want to focus on the trajectory. Investing, that's why we say investing is all about the future trajectory. And as long as the ROC profile is improving over time, as long as the capital allocation is solid and the management is not engaging in bad capital allocation or value destructive capital allocation. And I say value destructive capital allocation, I'm referring to investments in which the return on capital is less than the cost of capital of the business. So as long as the capital allocation is solid, as long as the growth prospects remain healthy, just stay put, of subject to valuations, of course. If there is one big thing that has benefited me immensely in my investing, trading, and wealth creation journey over the years, it is this: listening very attentively to and learning from peers, seniors, and juniors who are much more smarter and hardworking than me. So one should always be humble. The more you reach out to and associate with individuals, whether younger or older, who are better and smarter than you are, the more you will learn and the faster you will improve. It is better to be an average guy on a star team than a star on an average team. The former will be better for you in the long term. The latter is just an ego trip. And the people closest to you play an outsized role in your level of success or failure. So choose wisely. You are, after all, the average of the 5 people you associate with the most in your life. And the beauty of today's digital age is that there are so many bright and hardworking investors and traders on Twitter, WhatsApp groups, and Telegram channels. And all I need to do is listen attentively to what they are sharing and then sincerely do the required study at my end. And there has never been a better time to be a humble and grounded person. Waldo Emerson had said, and I quote, "Every man I meet is my master in some point, and in that I learn of him." Learning and accepting help from others creates value far beyond our individual capabilities. So look at every interaction as an opportunity to learn from the people you meet. You'll be amazed at how quickly you grow and how much better you become, both as a professional and more importantly, as a human being. So keep learning from everyone. In August 2020, I tweeted about how I had watched a webinar by one of my junior colleagues named Soumya Malani, and I had noted down a key learning from him in through the Solara Active Pharmaceuticals demerger case study, which he had discussed. And on 4th August 2020, I had applied that very learning from him to Aarti surfactants when it experienced heavy trading volume after a series of lower circuits. And after hitting a series of lower circuits on that particular day, finally the lower circuit got broken and the selling pressure had been absorbed and had entered the particular script. And since August 2020, August 4th, 2020, the stock of Aarti surfactants went on to give more than 600% returns from there before giving up a large part of the gains in the last few months. Having understood how to play the demergers from my colleague, I used that very same learning again on 29th March 2021 to a stock named Jubilant Ingrevia. And since March 2021, the stock of Jubilant Ingrevia went on to give more than 200% returns before pairing a large part of the gains in the recent market correction. Now, here I would like to explain that there are various ways to play demergers, but in my experience, the really big money in demergers is played through two ways: a market cap demerger and a sectoral demerger. So let me explain, what does the market cap demerger mean, first of all. Aarti Surfactants had got demerged from its parent company Aarti Industries, and because Aarti Industries had some DII and FI holding, some institutional shareholding, when those institutional investors were handed over shares of this microcap Aarti Surfactants, they did not want to have anything to do with this microcap, so they tried to dump the shares in the open market at any price they could fetch for it. Because of their institutional mandates, many of institutional investors are not allowed to invest in stocks below a certain market cap size. So when they get handed shares from a demerger for microcap size company, they engage in forced selling. So that's an example of a market cap demerger. You want to basically track this particular dumping of the shares by these investors on the open market and just be alert as to when the selling pressure has got completely absorbed. The second way to maximize returns from a demerger through forced selling is that of a sectoral demerger. So in Jubilant Ingrevia's case, it was demerged out of Jubilant Life Sciences. And even though Jubilant Ingrevia listed at a decent market cap, because it was a chemical stock and because its parent company Jubilant Life Sciences was held by many pharmaceutical funds, again by their very institutional mandate, they were not allowed to hold a chemical company. Even though Jubilant Ingrevia was a just a just a standard decent chemical business, but and a decent market cap. But because those pharma funds were not allowed to hold a chemical stock in their portfolio, they again engaged in forced selling. That in turn got the stock price of Jubilant Ingrevia down 40-50% post listing. So that is how you make the really big money in demergers, when there is forced selling because of a market cap demerger or because of a sectoral demerger. This was some past case studies. Now I'll give you an upcoming uh, sectoral demerger. What's going to happen? So Aarti Pharmaceuticals is going to get demerged from Aarti Industries again. Again, the same thing will play out. All the chemical sector funds which are holding Aarti Industries, they will not be allowed to hold a pharma stock in their portfolios. And as a result, you will notice the shares of Aarti's Pharmaceuticals facing forced selling whenever it gets listed later this year. A similar case may or may not, I'm not sure, but may play out in the domestic wiring harness business of Motherson Sumi, which has got a very big FII plus DI holding. When the domestic wiring harness business gets listed next month, then that time that may also face some selling pressure because it may fall under the market cap demerger category. So just be on the lookout for whether there is any forced selling in that particular stock after listing. So I talked about management promoter change in the beginning of the presentation. I talked about demergers right now. What is the ultimate form of a special situation? It's when you get demerger coupled with a promoter and management change. So in September 2021, Advent, the private equity giant, acquired the Eureka Forbes business, the crown jewel of Shapoorji Pallonji Group, for an enterprise value of 4,400 crores. Again, this was an instance of forced selling because Shapoorji Pallonji Group, as of September, had a total debt of 20,000 crores, and in order to pay their debt, the group was forced to part with its crown jewel asset. That is the Eureka Forbes business. Now, if you simply look at the price to sales or market cap to sales multiple, which all the leading consumer brands in India enjoy, like Symphony, and if you simply compare that with what Eureka Forbes will list at, it was very clear that there was a profitable opportunity at play. So even though the stock of Forbes and Company has already given good returns since September of last year, I think once the Eureka Forbes business get listed, it may get a further re-rating boost after that. And again, let's talk about that important slide on the process. I talked about how you want to stack multiple layers of positive probability on your side. So in this case, the first layer of protection which you got was a reasonable entry price. The second layer of protection or the advantage you'll get is that Advent already has a proven track record of turning around consumer companies in India. They have had a very successful track record of turning around the Crompton consumer business in the past. They created a lot of value. So the base rate of success is pretty reasonable to high in my view for this particular turnaround also to happen. Even in a company like DFM Foods, which Advent took over, if you look at all the series of steps they took to maximize the return potential of the business, I think they have taken all the right steps. It's just that because schools and the primary target audience of that particular business, they were not, they were basically disrupted by the pandemic. That's why that business of DFM Foods has not been able to turn around yet. But in case of this particular situation of Forbes and Company and the Eureka Forbes business, because it won't be affected by the pandemic like DFM Foods was, I think the base rate of success in this particular situation is much more favorable. So what is the big insight that we get from all this? It is that all intelligent investing is value investing. If I had not self-educated myself on different areas of value in the markets and instead restricted myself only to one way of investing, then I would have never been able to participate in broad-based bull markets. My personal investment opportunity set has significantly expanded over the years with time and experience in the markets. Initially, I started off by investing in low price to book and low price to earning stocks because I started off like most investors by reading Graham's The Intelligent Investor. Then I read Buffett, Munger, Phil Fisher, and then I started investing in quality businesses at fair prices. But today, it covers multiple areas of the investment universe, including deep value, cyclicals, commodities, turnarounds, special situations like merger arbitrage, demergers. And instead of being restricted by my personal biased views to a small opportunity set, as was the case in my early years, I'm now able to invest in a variety of industries and situations wherever I find mispricing of value and a highly favorable risk and return trade off. You see, no single strategy works all of the time and in every kind of market. And that is why it is essential to build up one's investing arsenal to be able to hunt for value from within different areas. And over the years, I've come to realize and appreciate just why this is so critically important. It is because a bull market is always going on at all points of time in some specific sectors of the Indian stock market. Between 1960 to 2000, it was in technology, media, and communications. Between 2003 to 2008, it was in infrastructure, commodities, real estate, organized retail. Between 2009 to 2014, it was in discretionary consumption, pharmaceuticals, IT services, FMCG. Between 2015 to 2018, it was in autos, specialty chemicals, financials like NBFCs and microfinance companies. And since March 2020, a new bull run has basically emerged in the import substitution place and various sub-segments within India's manufacturing industry, contract development and manufacturing organizations, contract research and manufacturing services, building materials, housing finance companies, ethanol blending, digital transformation, electric vehicles. Multiple trends have emerged since March 2020. And it is my personal belief and conviction that the opportunities in the next 20 years in India will be far greater than those in the past 20 years. And the opportunities of the last 20 years will be dwarfed by the opportunities of the next 20 years. And where will those opportunities come from? They'll come from two sources: variant perception and long term structural trends. Variant perception refers to situations where you get earnings growth coupled with ROC expansion and you get valuation re-rating and you end up having multi-baggers. And variant perception comes from a differentiated view on the short to medium term trajectory of the business. There are various triggers for variant perception, namely product mix change, which can lead to margin expansion because margin expansion is a key driver of ROC expansion. It can come from Capex, which in turn can lead to operating leverage. Once the pre-production costs have been recovered, the company can experience operating leverage. After that, if the company engages in deleveraging, you can get a further boost because as the debt goes down, interest costs go down, net profit goes up, market cap goes up. Variant perception can also come from an industry cycle shift, like we saw how the residential real estate cycle turned around from the middle of 2020. That's an example of an industry cycle shift. Another example of an industry cycle shift that we're witnessing right now is that in the capital goods industry. Recently, Kumar Mangalam Birla talked about a Capex Mahotsav in India over the next 10 years, driven by especially by the PLI scheme. So capital goods, especially the industrial consumables or items having repeat usage within the capital goods industry, they can provide very good alpha generation. So investors should definitely study those areas. Variant perception can also come from a regulatory change. So since early 2020, we have seen a heavy emphasis by the government of India on ethanol blending, and that has already led to many multi-baggers from the distillery space. Variant perception can also come from improvement in asset turns. So this is information which you can easily get from conference calls. You can actually ask the management what is the expected asset turnover on the new capacity. And between margin expansion and improvement in asset turns, I prefer the latter because high margins tend to attract competition. Variant perception can also come from corporate actions like demergers, reverse mergers, promoter management change. It can also come from divestiture of a loss-making business because as the loss-making business gets sold, the remaining company's net profit goes up, market cap goes up. Variant perception can also come from divestiture of a non-core business because many conglomerate companies in India get what is known as a conglomerate discount. But the stock markets like focus. They like focus managements, focusing on the core business. So whenever management sell off the non-core businesses, which are low return on capital employed businesses, those stocks tend to get further re-rated. That was about variant perception. Now we come to long-term structural trends. Long-term structural trends are found in industries with a favorable structure. They're usually organized as a monopoly or a duopoly or an oligopoly at best, and they're experiencing some form of an industry tailwind. They have consistency and predictability of cash flows. They have a long runway for growth. So you have high visibility for many years ahead. They also tend to be characterized by value migration. So in India, we have had value migration going on from unorganized to organized, public to private, offline to online. There are multiple structural growth plays in the Indian market. CDMOs, CRAMs, contract manufacturing, specialty chemicals with critical application, animal healthcare, fintech, music streaming, e-commerce, electric vehicles, digital transformation, and cloud computing. And Now I'm about to share a very important principle for value creation with all of you. There are two kinds of businesses in the stock market, one with low returns on capital employed and one with high returns on capital employed. In case of businesses with low returns on capital employed, the maximum delta, the maximum rate of change, the maximum intrinsic value creation takes place when they focus on improving their return on capital employed. And that comes from focusing on variant perception. In case of companies with high returns on capital employed, the maximum delta, the maximum rate of change, the maximum intrinsic value creation takes place when they focus on increasing their top line growth. And that is what we focus on in the long term structural trends. So, at Stellar Wealth Partners, our Stellar Wealth FlexiCap small case is primarily based on variant perception, and our Stellar Wealth Megatrend small case is primarily based on long term structural trends. Both of these are benchmark agnostic portfolios of 25 to 30 names each. And in case anyone wants to understand the rationale for having 25 to 30 holdings in each of these small cases, it's because that is the optimal number of holdings to maximize the risk return trade off. As per a study published in the international bestseller, A Random Walk Down Wall Street, as the number of stocks in a portfolio reaches 25 to 30 names, the incremental volatility reducing benefits of diversification reach near zero. This is the sweet spot for an active investor seeking to outperform the market. At 25 to 30 stocks, you have captured almost all of the benefits of diversification, yet the number of companies you need to know thoroughly is still manageable. I would like to conclude with a brief about how value investing, in my view, is a life discipline. So, investing is a field of competitive learning, and Benjamin Franklin has put it very aptly that an investment in knowledge pays the best interest. Warren Buffett concurs: the more you learn, the more you'll earn. The best investment you can make is an investment in yourself. In August 2016, Michael Mauboussin had authored a brilliant paper titled 30 Years Reflections on the 10 Attributes of Great Investors. And in one of my past interviews on Stock and Ladder blog, I'd shared those 10 attributes along with some of the best ratings on each of those attributes. So let me just outline those 10 attributes for the benefits of our audience. Be numerate, understand value, properly assess strategy, compare effectively, think probabilistically, update your views effectively, beware of behavioral biases, know the difference between information and influence, position sizing, and reading. And I'd added three more attributes to that list, namely extreme levels of patience coupled with the ability to act decisively, multidisciplinary thinking, and inversion. So keep learning and keep growing. That is my key message to all of you today. The value investing discipline has certain finer aspects that we come to realize and appreciate only with the passage of time and with experience. With the passage of time, we learn to recognize that value investing is not merely about stocks and business fundamentals. It is a life discipline. And I've explained the same in my books section on overrated and underrated behaviors, and I'll share a few of them with all of you. Knowledge is overrated. Wisdom is underrated. Intellect is overrated. Temperament is underrated. Outcome is overrated. Process is underrated. Forecasting is overrated. Preparation is underrated. Confidence is overrated. Humility is underrated. Conviction is overrated. Pragmatism is underrated. Complexity is overrated. Simplicity is underrated. Analytical ability is overrated. Personal behavior is underrated. Having a high income level is overrated. Inculcating a disciplined saving habit is underrated. Competition with peers is overrated. Helping them is underrated. Large personal net worth is overrated. Good karma is underrated. Talent is overrated. Resilience is underrated. Being the best investor is overrated. Being the most authentic version of yourself is underrated. I would like to end with two key messages from my book that the goals of investment should be happiness, joy, growth, intellectual satisfaction, and eventually peace and serenity. Wealth and financial prosperity are natural byproducts of lifelong learning. And many people achieve success, but to sustain the same and potentially build on it over an entire lifetime requires humility, gratitude, and a constant learning mindset. For any feedback or queries, feel free to connect with me on stellarwealthpartners.com. I can also be reached on LinkedIn and Twitter. You can learn more about my chapter on investing titled The Discipline of Investing at getchapter.app/Gautam. readers can get their copy of the book on Amazon, Google Play Books, and Book Depository website. And you can also email me at info@stellawealthpartners.com. With that, I come to the end of my presentation. Thank you, Vikas.
Yeah, thank you, Gautam. I think it was a great presentation, a very detailed one, and we truly, appreciate the kind of efforts that you have put into to prepare this presentation. You can turn off the presentation, and we'll have, if you allow me, we'll take some questions.
Sure.
Yeah,
Yep.
you're okay taking some questions, right?
Sure.
Okay. So, few questions quickly. One is, where do you see Nifty to be 10 years down the line?
Not even God knows where the Nifty levels will be 10 years down the line. I think it's basically meaningless to focus on indices and the index levels because that's just short-term distractions and short-term noise. Ultimately, at the end of the day, if you focus on good stocks, you'll do very well over time. In fact, in my book, I've shared a table, if you recall, about a list of great businesses and bad businesses from India in January 2008, which was the peak of the previous bull market. And I've showed the stock price performance right from the peak of that previous bull market till the bottom of the subsequent bear market. And what that table shows is that the great businesses, even when measured from the previous bull market top to the subsequent bear market bottom, they end up creating wealth across market cycles, even in the middle of negative headlines like rising interest rates, rising inflation, geopolitical tensions, disease outbreaks, and the like. But bad businesses eventually destroy wealth, irrespective of whether the headlines are positive or negative. So just focus on the underlying business. I'll give you one more very good example here, which I've shared in my book as well. From December 1964 to December 1981, the Dow Jones Industrial Average advanced only 1 point from 875 to 876. But Warren Buffett compounded his capital at 20% CAGR over those 17 years when the index gave zero return. That's why I keep saying that investing is all about individual stock picking.
Okay. Next question is, sir, current geopolitical risk and interest rate is a big risk for us. So how much cash position has to be kept now? Always something is going on. So what is the strategy to deploy capital in portfolio systematically?
You also just said it right. So always something is going on. There's always something in the world to worry about. But yeah, see, we have to evolve our mindset to that of the big investors like Ramesh Damani, Ramdev Agarwal, Rakesh Jhunjhunwala. Just ask yourself, what would Rakesh Jhunjhunwala do in this situation? Would he sell his Titan shares just because there's particular geopolitical tension taking place between Russia and Ukraine, or there's an interest rate hike? No, right? There has been, in fact, many years. I think there have been stretches of 4 5 years in the past when Titan stock gave zero returns. But did Jhunjhunwala sell even a single share of Titan? No, right? Because as long as the growth prospects remain robust and the valuations remain reasonable, he did not ever want to sell out of a great business. So once you have found the goose that lays the golden eggs, don't kill the goose. So just stick on.
All right. Next question is, she's one of your investor. So hi Gautam, I've subscribed to your Stellar Wealth small case. What shall I do when I have already some of the stocks in my personal portfolio? I think she's referring to the duplication, and some of them at a higher than the allocation percentage mentioned by you in small case.
Right. So basically, the advantage of small case is that you are free to follow or not follow the advice of the small case manager. But in order to get the full benefit of the annual fee which you're paying, it is strongly recommended for you to strictly follow the model portfolio at all times. Even if you have an existing portfolio which has stocks common with that in the small case, I would still recommend you to strictly follow the model portfolio allocation, because that is how you'll be able to understand better over time whether you're actually getting the full benefit of the annual fee. That is the whole reason why you're paying the annual fee, right? You're paying to get the recommended weightages and the allocations, the sectoral and the stock level allocations from the managers. So strictly follow the model portfolio allocations is what I can say.
I agree with Gautam. I think it's very important that you align your portfolio with the portfolio manager, because sometimes they do change some weightages in the portfolio depending upon how the order book looks like, how the overall company's valuation looks like. So it's very important. And the second question is, how do I get my portfolio change intimation?
So,
Uh,
so all
yeah.
these small case clients are basically given a notification on their small case mobile app at 9:15 a.m. on the morning of the rebalance, And after half an hour at 9:45 a.m., they also get an email notification of the change. All that they need to do is click on the link in the rebalance email and click on confirm update, confirm rebalance, and the rebalance is done automatically by the small case app.
Yeah, so the moment you click on that rebalancing, automatically it would rebalance the portfolio. All
Right.
the stocks will get sold in the market, through your broker.
Yes.
So whichever
Yes.
broker. So yeah, I'm familiar with that. So I'm answering this on behalf of small case. The other question is, what about PMS? So Mr. Singhal, the PMS is not started by Gautam yet. And last time when I spoke to him, I kind of advised him and requested him to start his PMS, and he's seriously thinking about it. It might take some more time. So we'll come back to you and let you know. The next question is, where do you think markets are in India from a business cycle perspective?
I think we're in the sweet spot of the business cycle. That's a good question. I think we're in the sweet spot of the business cycle. And this is why the recent correction is actually exciting me because, see, in a bear market, like I said, when the earnings growth dries up, when you don't have earnings growth and when stock prices fall, that's a very depressing state of affairs. But in a situation like today, when you're about to enter a capex upcycle and a real estate upcycle, and when earnings growth are about to exponentially accelerate across sectors, in these situations when stock prices fall, it's like a godsend for all investors like us. So right now is the time to be excited, not be despondent, because the only time you want to be despondent is when the earnings growth prospects of your stocks is going down. But if the earnings growth prospects are improving and the stock prices are falling, that means the implied future returns are actually going up. They're not going down, they're going up.
The other question which I keep getting is this the good time to invest, or should we wait for correction to come? I mean,
I've
this
been
is one question
so
I always get.
yeah,
So
this
what?
is a question which we keep getting all the time, and I keep telling people that Sensex started at 100, then it went to 1,000. People said it's overvalued. Then it went to 10,000. People still said it's overvalued. Then it went to 20,000, 30,000, 40,000, 50,000, 60,000. And people are, I've been, many people have been crying all the way up that it's overvalued. But over time, just because that's just driven by the sheer power of compound interest coupled with nominal GDP growth, over time, Sensex will eventually scale 1 lakh. It will even eventually scale 2 lakh and above. You have to stop worrying about where the market is headed, where the market is going, because no one frankly knows these things in the short term. The long term trajectory is up. So you have to be a long term optimist if you want to succeed in the market. Just be, but at the same time, be prudent at all times, but have a long term holding orientation and a long term optimism mindset. That's how you'll succeed.
Next question is, what's your views on current corrections, the recent correction that Indian market faced?
So this is where studying history helps a lot. So because I've been a very ardent student of financial history, and because I have seen even during the 2003 to 2007 bull market, which was a life-changing bull market for many people, even during those 4 5 years, you had multiple corrections. Even much more. This recent correction, frankly, is nothing. If you look at the past bull market, you have had corrections of as high as 30% also during those 4 5 year long bull market. So corrections are a very routine feature of the stock market, be it a bear market or a bull market. These corrections keep happening every now and then. For instance, like during 2011, we had a severe correction. During 2013, we had a severe bear market in small cap, mid caps. During 2015, 16, again we had 20% falls. During 2000, from January 2018 to March 2020, the small cap index fell 60%. Individual small cap stocks fell 70%. So just be a student of financial market history. So you'll understand that downside volatility is a routine feature, but that is why you get disproportionately rewarded with big returns in the long term. It's for enduring those interim short-term downturns.
Okay, yeah. So next question is, it's always great to listen to your session on discipline of investing. How do you see banks overall going ahead? And it has not given any return so far in last 1.5 years. How do you see energy sector and any few energy related stocks that you would like to share for study purpose?
I think both of these sectors should do very well, especially banks. I think no capex upcycle and real estate upcycle can take place without the banks and lenders participating. So at Stellar Wealth partners in our flexi cap small case, we have got good exposure to lenders, high quality lenders in our small case, and like I'm very clear about the next 10 years, we're going to have a capex mouths of like Humamalam Birla is talking about, and in such an environment, banks will definitely give very good returns. I think all these short-term disruptions which we keep on seeing recently, especially what has happened is we all know that banks are the most heavily overowned sectors by FIs in the Indian stock market. So whenever there is FI selling, by definition, because they're overweight banks, the bank nifty and the banking sector tends to outperform. But that's more of a technical reason. You look at what happened with ICICI Bank recently, not a stock recommendation. We hold it in our flexi cap small case. So ICICI Bank reported a brilliant set of quarterly numbers, but even after that, the stock price actually fell because the market collapsed 1500 points on that particular day. The Sensex fell sharply. This is an example of a coiled spring. Earnings growth and the prospects are improving, and the stock price is declining. These are the kind of opportunities which investors should look for during every correction. You look for companies which have reported a blockbuster quarterly earnings report, but whose stock prices are still falling. That is where you will get the big returns going forward.
All right, with that, we'll conclude the session today. I think we've taken more than 1.5 hours. So thank you so much, Gautam. It was pleasure listening to you, your ideas, your framework in which you evaluate various industry markets and as well as certain stocks. So thank you so much. Thank you so much for taking the time out and joining the session today.
Thank you, Vikas. This was a pleasure. Thank you.
Thank you.